Bismillahirrahmanirrahim. So today we're just covering chapter 4 of the Minsky book. So the chapter starts with three quotes. A bank is not a money lender that first acquires then places funds. Banks lends or invests then finds the cash. ये बहुत अहम है. मनी लेंडर जो है वो उसके पास पैसे होते हैं, पहले कहीं से वो पैसे हासिल करता है, फिर वो उनको देता है. The bank makes loans first and then acquires the money to cover. Reserve money जो है वो खुद ही exogenous नहीं है. In the sense that the central bank makes decisions and doesn't have control of the amount of reserves, as we will see later. So multiplier is second stage. Reserves themselves are not under control of the central bank. And money matters a lot, sometimes not, sometimes more, and sometimes not. So quantity theory may hold in some periods of time, but may not in other periods of time. And actually Minsky tells us about when it is important, when it is not so important. So the crucial thing which economists fail to do is that every transaction has two sides. Yani when we sell something, then somebody receives a good and the other party receives the money. So every thing is a double entry. It enters into one book in one way and the other book at the same time in another way. That is why, see, when you don't look at the balance sheet, then you don't understand that the net profits of the firms plus the net savings of the private sector must equal zero if there are no money injections. So Krugman is quoted to show that he has a common misunderstanding. This is what Krugman says, that when the banks lend money, it lends money from the deposits. You can't just issue checks out of thin air. They must buy assets with funds they have on hand. This is just a wrong but common misunderstanding. So the Bank of England in 2014, there is a paper called Money Creation in the Modern Economy, and this is a quote from that. Money creation differs from popular misconceptions. Banks do not act as intermediaries, lending out deposits that savers place with them. Nor do they multiply up. ये दो common misconceptions हैं कि central bank रिजर्व देता है और उसके आपकी रिजर्व रेशियो 10% है, तो देन यू कैन क्रिएट $90. दिस इज ऑल्सो नॉट ट्रू. The reality of how money is created differs from the description found in economic textbooks. You make a loan out of thin air. When you make a loan, there is nothing in sight. You just give a loan and you create an electronic account which the book calls it keystroke money, because so you just enter on your computer that this account has so much money in it. That's all. This creates new money. The new money that didn't exist in the economy came into being. Balance sheet wise, the deposit account of the bank is a liability. The bank will have to pay out of this, and an asset is the promise to pay which the other person has made of the loan. So what do banks do actually? So the key insight of Minsky is that anybody can create money, but the problem lies in getting it accepted. We also saw in the last lecture that the King of England, King William, he could not really make money, even though it was his guarantee that the bank used to make money. So the issue was not that the king could issue IOUs saying that, and if everybody accepted that, that would be money. But the king's IOUs were not very acceptable because people couldn't cash it in for gold, for one thing. And the other way to make it work is to say that this is law, everybody must accept this currency and use this currency. That power had been taken away from King William by the Parliament. So The problem is that, okay, my IOs can't circulate if I don't have trust, but the bank's IOs could circulate. So the bank took the king's IOs and used that as the basis for creation of money. So why the bank is not a money lender is why Krugman's view is wrong, and why the view is basically, if you look at the economy, there's about $1 trillion in cash, but the IOUs of banks are around 10 trillion. So it can't be that the money is being traded around. Where is this additional money come from? It's coming from IOUs which the banks circulate on the basis of the money that is in existence. Banks do not take in cash. One of the arguments that is that suppose that bank makes a loan of $150,000. So is it any people are bringing in their change and other monies, and that money is taken in a wheelbarrow and sent to the... It doesn't happen like that. People do not actually bring in lots of cash into the bank. People write checks. Now the checks are already IOUs on this created money. And so what happens is that keystrokes are exchanged. Cash is not exchanged. People take cash out of banks. People don't put cash into banks. And when people ask for cash, then the bank asks the Fed to print money to give it. And the same thing happens in Pakistan. When the bank, you go and cash a check, the bank converts some of the electronic money it has with the central bank into printed notes and gets them to pay. Now the important thing is that when the bank asks the Federal Reserve Bank for reserves, that look, I have to pay so much in cash. So what happens? Can the bank refuse? The central bank cannot refuse according to the law. So the bank has to create reserves on demand. So basically then the reserves are created on demand of the private sector. They are not created exogenously at the control of the central bank. So the book says that banks create money when they lend. When the Fed gives reserves to the bank, where does this come from? It also comes from a keystroke entry. It does not. It's always... when the banks say, okay, we need some cash, the Fed just prints the money and sends it. It comes out of nowhere. It's not... money is always created out of thin air as a double entry. It's not where does it come from. We can create money because if I write you an IOU, it's money that has been created. And basically the issue is, can it circulate? So it can also circulate if it's permissible and if it's taken as reliable, that I will pay the bearer of this note 1,000 rupees whenever this note is presented to me. Then if my name is good, if people recognize and understand and believe that this promise is good, then they will trade. They can use this for trading, and so money has been created. So anybody can create money. The issue is how to make it generally acceptable. So once we understand that, then we can understand shadow banking. These came into existence after the deregulation started in 1970s. When I was in the USA, these things were starting. These were called now accounts, money market mutual funds. Now you can put money into the stock market. Now basically the key effect of Glass-Steagall was that they separated investment banking from commercial banking. And so basically the investment banks were supposed to be for investment and checking accounts were supposed to be safe and solid. Now you couldn't get high returns on your checking accounts. Now these barriers started to be removed in 1970s, especially with the coming of Reagan, and they became much more loose. So what they did was they introduced these funds where you can hold stocks. You say, I have 1,000 rupees and you're going to put this into stocks. The bank is going to... But at the same time, you can write checks on this And so you have an account, it's being held in stocks, but you can also write checks on it and you can do normal trading. So now you have the option of getting, and you can do lots of things in these accounts. Similarly, people started creating real estate accounts where your money will be pooled to buy real estate, but also it will act as a checking account. You can take it out whenever you want. Now this is the dangerous part. You see, if you invest, then your money is locked up and subject to risk. But what these accounts did was they mixed up these two things. You can even get a credit card to use backed up by that account. But the problem with these accounts, the shadow banks, so these are shadow banks because they are creating money. Because once you write a check, and if they give a loan, or they can give a loan like this, they can say, okay, you can use $100 and we will hold $1,000 worth of stock for you. So you take $900 from us, and that is backed by the collateral of the stock itself. So now they have created $900 of money. So this is a shadow bank. Similarly, there are many other techniques and tricks that you can use to create money. Now the difference between this shadow banks and real banks is that the FDIC guarantee, Federal Deposit Insurance Corporation, if your bank is wiped out, then the government ensures that the depositors will get their money back. In 2008, after all of these shadow banks collapsed, then the guarantee was also temporarily extended to these shadow banks just to keep the system running. So different assets have different degrees of liquidity, which might also be called moneyness. How quickly they are convertible to cash is the. So this debate is called the debate about endogenous versus exogenous money. So Krugman is a believer in exogenous money. Money is fixed out there. It cannot be created. It cannot be destroyed. So it's just like, basically it's exogenous money is gold. Gold is money and nothing else. So it's solid, hard. You can't lend, you can't create money because it's fixed. If you want to lend somebody gold, you have to get gold first. You can't lend somebody a piece of air and call it gold. So that's exogenous money. Endogenous money is, on the other hand, the theory that we are studying, Minsky's theory, that when private sector can create money at will, then this money is endogenous, meaning that it's not determined outside the system. The system itself determines it. This distinction between exogenous and endogenous, this is very crucial to understanding, and nobody really explains it very well, especially in econometrics, but also in standard economics. Nobody understands this exogenous endogenous business, because you see, when you take your supply and demand model, the price is an endogenous variable, because it is the equilibrium price is determined by the intersection of the supply and demand. Now so the system determines the price. The demand curve is determined by the incomes and tastes, and the supply curve is determined by the costs and the production functions. And the price is determined by the system. So tastes, income, technology, costs of resources, all of these are exogenous. So you can talk about the changes in taste, you can talk about changes in income. All of these things will affect the price through your supply and demand model. But you cannot talk about changes in price. This is something which is not understood by your basic textbooks. They say, okay, demand curve, how do we construct the demand curve? We change the price. But how did the price change? The price is not allowed to change, because unless something exogenous changes. So if thinking about in common sense terms, suppose I say that, okay, the price of coffee, you are a coffee lover, so price of coffee is going to double. So what will your demand response be? Well, you will ask, why did the price double? Is it because there is a shortage in shipment, and so tomorrow it will not be, it will be double, but day after it will come down? And unless you know, is it the supply side? Is it that everybody has started suddenly drinking more coffee? So your response will depend on why the price changed. It will not depend. You cannot answer this question because price cannot change, and you know it. The price cannot change just exogenously. Exogenous variables can change. Endogenous variables cannot change without something exogenous changing. And economists, basic supply and demand model doesn't understand this basic point. So anyway, money is being taken as exogenous by economists, whereas in fact it is endogenous. Once it is endogenous, then you have to study what are the factors which cause changes in prices. But economists are nowhere, because once you start thinking money is exogenous, then you cannot study the factors which cause changes in money, and then you cannot get started on understanding economics. So if money is a fixed multiple of reserves, it's exogenous. Classical theory, which is the Friedman's theory of money, this is the classical theory that, okay, there's a fixed amount of reserves, that's gold, then the banks have a maximum, if 10% reserves, then they can create 9 times the reserves, and that's what they will create, because you always have incentive to create as much as you want. So that fixes the stock of money. Now once the stock of money is determined, then the interest rate will adjust to equilibrate the supply and demand for money. So this is the classical theory, and it's completely wrong. In fact, the banks create money whenever they can find somebody credible worth lending to. This is very important. Banks want to create money, but they can only create money if somebody borrows it. They cannot create money and keep it in their pockets, because then it's not money. It's money when it's lent to somebody, and when a double entry comes into being. You owe somebody, he has a liability, and you have an asset, which is the loan, that the promise to pay, and then you have a liability, which is your promise to pay. So money is created out of nothing as a balanced transaction on two sides. So the banks create money whenever they find somebody worth lending to, and they borrow reserves as needed to service the loan, to meet the requirements. This is something that we will see. That is, when you acquire this, then there is a stream of liabilities that you acquire, because checks will be coming in at random, and there is a asset. This is a fixed payment 1 year from now of a certain amount. So there is a random liability, which is a stream of payments, and there is a asset, which is a fixed amount, which will be paid some time from now. So basically this issue, the revenue stream and the cost stream, and matching them, this is of great importance in understanding finance. Now actually lots of people have, the exogeneity money was the really dominant theory, and endogenous money was taken as a crackpot idea, only heterodox economists. But now a lot of mainstream economists have understood this simple point, and so endogenous money is much more respectable now, and most people, a lot of people agree with it, although there are some dinosaurs like Krugman. So what are open market operations? According to the textbooks that I read, which apparently are the same as the textbooks that you are reading, banks conduct open market operations to control the supply of money. This is not true. Technically what they do is, the textbook says that they want, if there's excess money, they mop it up, and if there's less. But actually what they do is they control the interest rate, the discount rate. So if the banks are making too many reserves among themselves, this will drive down the discount rate, which is set by policy. So when this starts happening, when the rates start going down below the discount rate, because people have lots of reserves, then the central bank mops up these reserves by starting to buy them at the going rate in the market. See, when the rate is below discount, then the central bank is in the market and buying up the excess money and selling bonds. And once it sells bonds at near the discount rate, then everybody will buy it instead of allowing the rate to go down because they get more. And similarly, if the rate is going up above the discount rate, then that means that money is tight, people are trying to borrow and they are not able to find the money. So then the bank injects money into the system by, whenever the banks, you see, borrow, they borrow against some asset, they offer some collateral. Either they can sell bonds to the central bank, or they can place bonds as collateral against a loan that they take from the bank. So in either case, the discount rate is protected. So that means, see, once you're protecting the discount rate, that means that you don't have control over the reserves. You can only control the reserves and let the discount rate be whatever it is, or you control the discount rate and then the money supply will be according to the market conditions. And that's what really happens. So the open market operations do not control the money supply, they control the discount rate. This was clearly articulated by Minsky a long time ago, but now these ideas are widely accepted. So, what are the financial institutions and what do they do? Well, a capitalist economy is a financial system. Neoclassical economics, the one that is being studied all over the world, is not useful because it denies that financial system matters. There was the classical dichotomy that there's the money is act separately. The money only affects the prices, and the real factors, the inputs, labor, capital, etc. These are what make a difference in the real economy. So this is the classical dichotomy. This is also expressed in the idea that money is a whale. This is also the idea at the heart of real business cycle model, which is the mainstream macro model in use today. And the big dispute within macro of the different schools is that some people, Lucas and extremists like him, say that money doesn't matter even in the short run. And the mainstream macro schools say that money does not matter in the long run, but it matters in the short run. But both of these are completely rejected by Keynes and the Minsky school. Money is all important. It's at the heart of the system. And once you reject the importance or relevance of finance, so you see, the way that money matters in the short run, according to the neoclassical synthesis, is that people are confused by the level of money. When the real price has changed, they don't understand that the real price has changed. So money can only cause distortions in the system. Money cannot do anything positive. The only thing that can happen, money can do, is confuse people about the difference between real and nominal. And so that's why Friedman proposed the fixed rate of increase of money stock rule, that this confusion should be removed. So money can never play a positive or a constructive role in the economy. That is always done by the real. But money can throw people off. So there was this theory of unanticipated price shocks. So basically, as long as the people can see what's happening, they can respond to it. But if the government surprises them by printing more money than it has announced, then people will be temporarily fooled. This will cause disturbance in the real economy, but ultimately this will be smoothed out as people realize what has happened. So the key issues, according to Minsky, is that the financial structure matters, is at the heart of things, and that it has fragility, risks. Again, these things are the risks and the varying level of risk. This is something that's outside the scope of understanding of economics, because according to the economic theory, when you have rational expectations that yes, you can have random variations, but everybody knows exactly what's happening. So the risk is known to everybody, and it is a fixed risk. Actually, there is there is something called uncertainty and risk. This was a distinction that was made by Keynes and Knight. These were two people. Both of them said that risk is like when you have a dice and you roll the dice, and so there are 6 possibilities and each of them has a known probability. So this is a risk situation. When you have a situation where what are the outcomes you don't know and what are the probabilities, a horse race is that is called uncertainty. A horse race is more like uncertainty because you have 10 horses in a race and you don't know the probability that which one will win. But even a horse race does not capture uncertainty because it's a horse race in which you don't know how many horses are entered and who is which horse is which, and you don't know anything about the relative qualities of the horses. So you have no idea about the probability. You don't even know this outcome space. So that is uncertainty. So that is something that the economists don't allow for. But in the real system, you have uncertainty in the sense that as financial innovations keep occurring, this is what, as the people try to block the creation of money, smart people find ways to get around this, because as we have said, anyone can create money, and how can we make it acceptable? You and I can think. I mean, if we want to create a new money, we can say, okay, student money. We are going to create a club of students in all universities, and this is student money. We will anybody can pay us money, and this will be special student money, and it will be usable at such and such places. And if you are successful in marketing it, you can create money, and initially you can make it 100% backing, that everybody, you pay a rupee and then you can get a student money. But if it gets acceptable, then you can only have 1,000 rupees in cash, and you can be having student money of 10,000, and you can create this money. So so anybody can create money and nobody can really stop it. So this creates fragility in the system, because this kind of money creation, which is unbacked, can be done by anybody, and then it can collapse. This fragility makes it likely that stagnation or deep depression is possible. A stagnant capitalist economy does not promote capital development. So if you make this completely, suppose you try to ban this thing, that okay, nobody can create money, then you have stagnation, because there are lots of projects, they need money, and you can't finance them because you have clamped down heavily. So this will cause your system to be less dynamic, and that's not desirable either. So you have this problem that if you don't allow financial innovations, then your capitalist economy won't grow. Maybe you shouldn't have a capitalist economy in the first place, but that's a question we are not considering right now. So basically, there is a problem in the sense that you can't, and solutions can be found if you do financial regulation and you do use government appropriately. So what's a capitalist economy? It's an interlinked set of balance sheets. Everybody has some assets and some liabilities. An asset is something which will yield an income flow, and as a liability is something in which you are promising to pay. So an asset is something which gives you a stream of income. If you have a house and you get rental income from it, then that's a asset which yields you income. This house can also be a liability in the sense that you have to make a payment for the house in some other time. So basically, excess of so a liability is technically a promise to pay X dollars in event of contingency C at time T. So something has to happen, like this is like insurance, that if somebody becomes sick or somebody has there's a fire, then you will pay so much money, at such and such time. So you can compute your assets and liabilities, and the excess of assets over liabilities is net worth. All economic units, households, firms, banks, government, we all have balance sheets. We take positions in assets, which means that we own assets or buy assets, and we have contingent income and liability streams. So you have an income stream. This is contingent on certain events. The income might come in if I get a job, for example, or liabilities are also contingent. If something happens, then I might have to pay, and I might not have to pay if something else happens. So you have an incoming income stream which is uncertain, an income stream of liabilities which is also uncertain. There is usually a gap between them. This gap is your margin of safety. Net worth, this is the amount that I hold currently. This is also a margin of safety. If there is a mismatch between my expense and my asset, then I can liquidate my net worth to pay for it. So if I have good net worth, then I have. Liquidity is also a margin of safety in the sense that my assets have varying amounts of liquidity. So if I have a house, this is not very liquid. It takes time to sell. So it is an asset. It is part of my net worth, but it doesn't add to my margin of safety by that much. Because if I have a short mismatch, my liabilities are greater, then I cannot sell the house, but I might be able to raise capital on the house by borrowing against it. That's a separate matter. So there is frequently a maturity mismatch. If the asset that I have will mature at a late date, but the liabilities occur in short run. So this always happens when the bank gives a loan, that okay, I give you a loan for ₹1 million and it's due 5 years from now with interest. Now I open an account, and now this is my stream of liabilities which I have to cover in the short term. So I have to make payments as soon as, whenever checks are written on it, and this could be regular checks are written every month. So I have a stream of liabilities. So now I have a mismatch. The amount that I have coming in is 5 years from now, but whenever I get a check written, I have to cover it, and I can cover it from my internal sources, or I can cover it by borrowing on the interbank market. But so there is a mismatch of maturities, and this requires refinancing. So a big check comes in unexpectedly. Now I have to borrow against it at some later date. So so an example of this is the 30-year mortgage. Suppose that I lend somebody ₹1 million to buy a house with. Now I have created this money, meaning that I actually give him cash. So I borrow somebody. I borrow 1 million from somebody, either reserves or interbank, and I give him cash, 1 million. And now I have a liability, and I have a asset. The asset is that every month he will be making me payments. But I also have a liability, which is my loan of the same amount. Now, as these as these payments come in, I can pay back the loan. But suppose that the demands that are made on my are higher, more than anticipated. I was expecting that less will be demanded. Then I have to cover by taking another loan. That's refinancing. And so refinancing depends on the conditions in the financial markets in the future, which are not known at this time. So the maturity profile is basically looking at all the stream of payments that I have to make and all of the streams of incoming. So when the new government came into power, they had to look at what are the dollar stream of revenue that is going to come in by date, and what is the amount payments that we have to make to foreign governments or organizations like IMF by date, and then they have to check for the match between them. So all of these issues are non-issues in a standard textbook because money doesn't matter, it's just a veil, but these are of central importance in a financial economy. Now that we have understood that there are frequent maturity mismatches, in fact the financial system is all based on mismatching maturities. You take a long loan and then you finance it short term, or you do the opposite. So every once in a while there will be a problem. You will have a loan that you have to pay, but your assets are not available at the current and they are not liquid enough for you to refinance them. So there are specialized financial institutions which take care of these, like the Federal Reserve Bank or the central bank takes care of mismatches for the private banks. But if there's a general market failure, then so the interbank market is an example where if you have a small mismatch, you can borrow from another bank. But if all the banks are failing, then you have a problem, and then that requires the lender of the last resort, which is a central bank, which can absorb any amount of losses, like $29 trillion were given to the banks to cover their shortfalls over the Now, although this can happen to anybody, and we can have a mismatch, but the financial institutions are special. Every agent in an economic system has a balance sheet. So mismatches can happen everywhere. But the financial institutions have some special characteristics. And in particular, they are highly leveraged, much more so than any other institution. So they have only cash of $5 and $95 worth of financial assets. This is true in the advanced financial economies. In Pakistan, it's much less leveraging. The banks are leveraged only about 30% or so. Now, in the USA and UK, where the leveraging is very high, the bank has very little skin in the game. There's very little they can lose. Even if there's $1 trillion loss to the market, they will only lose $1 billion or a small amount. So this is one of the key ideas of the Basel Accords, that the bank should have some more risk, otherwise the system is going to be at risk. So whenever you have a maturity mismatch, you need a backup plan, because your incoming and your outgoing are not matched, and they fluctuate randomly. So it's always possible to get in a situation where your safety margin is 0 and your current liability is greater than your current income. So the Federal Reserve Bank covers There's also Federal Home Loan Institution, which was devised to support mortgages. Mortgages put banks into a highly illiquid position. Their recovery was over a period of 30 years, and it was locked, so they couldn't. So the Federal Home Loan Institution allowed the banks to borrow against this incoming stream, which meant that they could do sometimes you have these the investment banks are especially risky because you want to raise a lot of money to finance a new business, but you don't know what the income streams are. So you can do it by selling bonds or stocks of that new business. So there are different types of banks. There's traditional commercial banking. This makes short-term loans which are covered by goods and services. And this was actually the basis of the so-called real bills doctrine. The fundamental loan which the commercial bank would make is that you, the seller or the merchant buys goods on a loan, and then it will sell these goods to get the money from which it will pay back the loan. So this is exactly how and in the time of the Prophet Muhammad sallallahu alaihi wasallam, the different tribes would put in money to buy goods, and then these goods would be taken for trade, and then they would earn some profits, and from these profits the people who had participated in the original loan would get back some share. So that was musharka type financing. So because the loan that is being given is against an asset which is being purchased, so there is a high margin of safety. Also, this is a short-term loan. Normally you buy goods and you sell them fairly quickly, or you hope to sell them fairly quickly. Investment banking is, on the other hand, much more risky proposition. You buy a factory, highly expensive, and then you're planning to do a business with it. You don't know whether it will succeed or not. The returns might take a long time. The factory might take a long time to build. So this is a different type of banking from commercial banking. So it has much higher risk. Universal banking is when you do all different types of banking at the same place. And as I've said, this is not a good idea. In fact, people have said that this is why failure. In fact, Glass-Steagall was one way to separate commercial banking from investment banking. And even today, there are proposals for narrow banking, create barriers to different types of banking, because mixing things up creates risks to the system. Basically, what happens is that the commercial bank functions. Basically, if you allow both of them, then the banks can use other people's money to gamble on investments, and when they win, they make the profits, and when they lose, somebody else loses the deposits. So they have a huge incentive to do this kind of thing, that they can make all the gains, and and they don't suffer any losses. And that's why it's important to prevent this universal banking and instead allow for narrow banking. Then there is this public holding company, which was basically devised to get around the barriers of that were created by Glass-Steagall. You have this holding company which holds one commercial bank in its portfolio, and also holds an investment bank in its portfolio. So now in this holding company, people can put money, and that it can be allocated to either commercial or investment. So it's allowed, and it's possible for this way to mix up the two, even though they are formally separated. So the commercial banking we already described that basically these banks make loans on short-term real assets, and that is the collateral that's usually pledged. They make these banks, commercial banks, are fairly safe. They make loans on mortgage loans, which are against houses, auto loans against automobiles, and basically anybody in the villages, the person who's buying groceries in the morning, he takes a loan from the local money lender, and then he purchases groceries. At the end of the day, he has sold the groceries, so he pays back the loan and he pays back the interest and he makes some profit. So this is the kind of lending that's going on. Now, there can be mismatches. That is when the bank opens a checking account, the checking account is in the full amount, but the asset will be coming in at the end of the period, which might be a year. So in the case of mismatches, it can borrow in the interbank market or from the Fed or from your own reserves. Banks do not have to have money in order to lend it. They can create this money. When the bank makes a loan, it creates money, and when the loan is repaid, this money is extinguished and the money supply goes down. In general, the banking business is about earning money from interest. This is distinguished from the pawn shop, where the pawn shop, the person gives his necklace or jewelry and gets a loan, and when he repays the loan, the person gets his asset back. The pawn shop does not make money on the loan. It makes money on the probability that the person will not be able to pay, and then he will capture the asset, which is much more valuable. Basically, it's a contingent sale. I sell my necklace with a promise that I can buy it back if I bring the money in a certain time. But the pawn shop is counting on me not to be able to do so. But the bank is not in this business. Even though the bank takes the collateral of the house as a mortgage, it does not expect to have to take possession of the house and foreclose it and sell it off in order to pay the loan. That's, if it were to do that, then it would be unsuccessful business. So this is very important to distinguish. So now, in the late 19th century, what happened was that the types of, basically capitalism was evolving and growing, and the types of projects that started coming in, building big dams, etc., were too big to be handled by commercial banks. And so the investment banks became more important. These investment banks are structurally different from commercial banks. They have to do different kinds of things. Basically, now you have to raise a large amount of money to finance a huge investment in a factory or in a dam, and the returns are uncertain, will be coming in late, not quickly. So the big banks like Goldman Sachs and JP Morgan rose, and they were able to do that, and these became more and more important. So this was a new type of capitalism, which is called finance capitalism in the last quarter of the 19th century. And basically, as we saw, this finance capitalism was destroyed by 1929, where it failed in a big way, and then the system itself changed. So what happens? What do investment banks do? Investment banks have two modes. They can say that, okay, here is a new business. I'm going to sell stock. So this is a stock in a venture. This is a company that's going to go out and develop land in Florida. And this will require millions of dollars to buy the land, to clear the land, to put up buildings, and then to sell. It will require multiple years. So rich people say, okay, here is $1 million. Like the same thing happened in the dot-com bubble, Amazon, things like that. So this business will eventually become profitable, but you bet on the prospects and you provide the finance for the business to run while it is not profitable. So you sell these equities. Equities are stocks. They will pay when the business starts to make returns. There are also bonds. The bonds say, okay, the business will promise to pay you a fixed amount regardless of what the business is doing, how the business does, regardless of it. So the bond is just a loan at an interest to the bank, but it is unsecured. This is the difference between the bond and the treasury. The treasury bond is a government bond, so it's guaranteed. But you sell the bond, you hope that the bond will be, the business will be, basically if the business does not collapse, then it will pay the bond. So it will pay the interest on your bond either by its own returns or by borrowing. But it's guaranteed to pay. But the stock, the value of the stock is just a share of the business. If the business is prosperous, then it will pay. If the business does not prosper, then it will not pay. So this is a difference between equity and bond. So investment banks hold long-term positions in capital assets. The investment bank, the asset of the bank is this business, which is maybe 10 years down the road it will become profitable. So this is something commercial banks do not do. They do not hold long-term positions in capital assets. It involves much greater risk, and also, very importantly for Minsky's thesis, much greater possibility of deception. Because basically you are selling prospects. So if you say that there is this land in Florida and everybody is going to buy it once it gets done, you are selling a dream, you are not selling a reality. And so you can cause deception. So one of the bankers said that I never saw a stock offering which I didn't like, because when the stock market, when the businessman is trying to sell his stocks, he has to present it in the best possible light. So the job of then the investment banker is to go dig deeper and find out what the risks are, which are not being shown in the prospectus, which only paints a bright picture. So the product that the commercial banks sell is an account. Actually, it's better to go back to 19th century. What the product that the banks in the 19th century sold were these banknotes. The banknotes came with a promise that on receipt the bearer will receive gold. So this was the product. Gold was not there. They were selling these, and the idea was that if this note is presented to me, I will somehow get the gold to pay it. It could be from my own reserves, but it's better not to think of this banknote as being a note on the reserve that you have. It's the note is floating, and you plan to finance it when it is presented. It can be from your own reserves, it can be from somebody else's. It doesn't matter. The own reserve or the extra, the asset is, the bank note is just a liability which you promise to service when the time comes, when it is presented. Exactly like this, the checking account is a liability and it represents a random stream of demand that will be made on you, and when the demand is made, you will find some way to create the cash to cover the liability that comes in. So the just like the bank note was a promise to pay gold, so the deposit account is a promise to produce the cash when required. Nothing now. The investment banks sell stocks and bonds. So now these are different from the commercial banks sell accounts. The investment banks sell stocks and bonds. So the stocks are the equities. These are long-term positions in business, very risky. What the value of it cannot be determined very easily because it depends heavily on expectations. This is very important. This is again something which conventional economics cannot understand, because when you go and evaluate an asset, if you do your accounting courses, they say, okay, here is the stream of incomes. And I remember that I used to wonder, but how will you know what the stream of income is? Yeah, you're doing your, you're calculating, here's my stream of incomes, and so you want to calculate the present discounted value, so you say, okay, this is current plus 1 year ahead divided by 1 plus r, and then 2 years ahead. But, 1 year ahead maybe you can predict, but 2 years ahead, who knows? So how are you going to calculate this? Present discounted value calculation seems like it's just a guess. So how, because there's so much uncertainty 2 years from now, that taking a random number and then dividing it by 1 plus r squared doesn't seem to make sense. You're making too accurate a calculation of something which is too much uncertain. So basically, the investment bank sells stocks. Now the bonds are much more certain, even if you have relatively lack of knowledge about how much the business is going to earn, because the business has promised to pay you 10%. So now the thing that matters is the solidity of the business. If the business survives, they will borrow to pay me. It's just a question of whether the business will be in existence or not. So that's why there are different categories. The bonds are ranked. Businesses are ranked. There are AAA and AA and single A, and then B grade, and then C grade. The lower grade bonds are called junk bonds, because they will pay if the business survives, but nobody knows whether the business will survive or not. So you can get high returns if the business survives. So if you can do your research and you think that this business is solid, and even though it is getting low ranking, so if there is a differential of information, you have more information, you have inside information, then you can make profits from that information. Were you able to see the movies? Somebody said that they had problems.
Yes, sir.
Okay. So Inside Job 2010 has a lot of information about this. So there was widespread deception in 1929 as well as in 2007, because investment banks were selling assets which they knew to be junk. In fact, that's how the Inside Job 2010 opens, with the hearing about a stockbroker who is being grilled in the Congress by somebody who says that that these bonds were junk and you were selling them to people. So basically in 1929, according to Minsky, the finance capitalism, the investment banks ended, stocks and bond prices collapsed, half of all the banks failed. Then the New Deal put in reforms, a lot of prohibitions and restrictions. These things created ceilings and floors. which prevented, first of all, the Glass-Steagall Act created a clear separation of investment banking and commercial banking. Commercial banking were very closely regulated to protect customers. Investment banks could do a lot more risky things, but they did not have access to public. This is really a crucial understanding, that basically, as long as the gambling is done by the people who have lots of money, it doesn't matter. The dot-com bubble collapsed in 1999. It was about the same size as the real estate bubble. Trillions of dollars were lost, but there was no impact on the economy because these were multi-billionaires who lost money, and it didn't affect general economy. But when the same bubble collapsed, when ordinary people were wiped out, then it caused a massive recession. So there was a clear separation. Investment banks could not offer deposit-making services to the general public, and the general public could not go and put money into investment banks. To put it bluntly, they would not be allowed to fool customers in the manner that they had during the Roaring '20s. In the '20s, there were huge numbers of investment schemes which general public was subscribing, and when these collapsed, as they are bound to, because when money is pouring in, fragility will keep increasing. So this set of regulations, which basically ended the finance capitalism, they remained in place for about 60 years. But so from 1920s to 1980s, but then basically the Reagan-Thatcher era was the era of financial deregulation. The separation of investment and commercial banking ended formally in 1999 with the repeal of the Glass-Steagall Act. There was another act which I have forgotten the name of, which was passed, which repealed this. But actually this was the formal legal, and the problems had already started earlier. Many ways had been devised to get around this barrier that had been placed. There were these now accounts, there were these money market mutual funds accounts where you could put money into the money market and also have a checking account, so that you could directly, then ordinary public could start investing in stocks, which is one thing that the barrier had been placed. And eventually this led to the same type of problem that had occurred in 1929. The general public was deceived into buying prospects which were paying high returns, and they were very risky, but the public did not understand the risks, and therefore the public was defrauded of a lot of money. And as I said, there's a difference between the collapse of the dot-com bubble, in which a lot of money was lost, about multiple billions, almost the same amount as was lost in the mortgages. But this loss was only to the millionaires, and so it didn't cause a general recession, but the mortgage bubble did cause a recession. So what are the conclusions? What do we learn from all of this analysis? Banking should not be described as a process of accepting deposits in order to make loans. Rather, it's a double entry transaction. The banks accept IOUs of borrowers, and this becomes their asset, and against this asset they make loans. That's the deposit account. This is exactly like the Bank of England, which takes the IOU of the king as its asset, and against it it creates banknotes, which are its liabilities. So the banking is not money lending. Money lending is exactly intermediation. You get money from somebody and then you lend it to somebody else. The business of bank is acceptance of IOUs, and making payments for the bank's debtors. So because the banks finance their positions, they buy IOUs and they sell IOUs, so there is often a liquidity mismatch, but basically their own assets they have very little skin in the game. That's what differentiates the financial institutions. So the banks their backup is reserves. So the reserves don't play the role of being multiplied to create money. The reserves are what they need to cover mismatches between incoming liabilities and incoming income streams and outgoing liabilities. These are frequently going to be mismatched. Whenever there is a mismatch, then there is a need for reserves. And that's how the reserves function. They cover these mismatches in financial liability streams. They don't have the function that the conventional textbooks teach you that they have. And these reserves can be borrowed on interbank, or they can be borrowed from the Fed, or they can be internal reserves. There is a reserve ratio. Reserve ratio again does not function like this, that the banks take reserves. Banks can borrow reserves as needed, so the reserve ratio does not have anything to do with the quantity of money. So this is again an issue of exogeneity versus endogeneity. If reserves are truly exogenous and money is a multiple of the reserves, then things could function as Friedman says they do. But the reserves themselves are endogenous. So the idea that they are multiplied to create money is again because reserves themselves are created to maintain the discount rate. Okay, so that's the end of chapter. Now I would like to go into some additional details about what are the consequences of this power of credit creation, which is simply not taken into account in conventional textbooks. So basically, one of the important consequences is that the lords of finance have a lot of power. Because they can create money, they can control the system, and they can control regulators, and they can control government. And basically this is what has happened. There is something which is called regulatory capture, and that's a very well-known phenomena. So you have regulation of banks, or you have regulation of monopoly. The idea is that the regulator is going to make sure that the banks don't misbehave in order to protect the public interest. Now, the public interest is very vague. The regulator is a government agency. He earns government incomes, which is on some BPS scales. The banks, they are rolling in money. The transactions that the regulator has to prevent are worth billions and billions of rupees. And so the banks have the incentive and the possibility and the capability of bribing the person to allow him to. So basically the regulators are captured by the banks and often used to their advantage instead of, and this is exactly what has happened in the energy sector. The problems of energy sector, the circular debt in Pakistan, is due to the faulty regulatory which was designed to protect the public, but now it's protecting the extra money that is being generated for the energy companies, and it is guaranteeing them profits at the expense of the public. So the basic key problem in the energy sector, the so-called circular debt, is coming from the regulations which are, instead of protecting the public, protecting the energy companies. So this was seen by everybody and has been seen a long time, that there are the financial lobby has a huge amount of power, and they can control the newspapers, and they can control the governments, and they can control the governments. Actually, in the USA today, the problem is no longer regulatory capture; it's government capture. The government has been captured by the finance, and this is the Pakistan. It's not true, but it's the financial lobby is very strong and powerful. When you have the Monetary Policy Committee, there is often a case in which the interests of the bank are opposed to the interest of the public. This is very commonly the case because basically if you have money is freely available, then the banks cannot make too much profits because their business is to create money. So if the government provides an easy money supply, then the bank's profits will be less because the product they are selling is not as much in demand. But this is helpful to the public. So the interests of the banks are opposed to the interest of the public. Now, on the Monetary Policy Committee, you have lots of bankers, you have lots of regulators who are capable and able to get jobs in the banking sector after they retire. So there is a strong conflict of interest. And in fact, recognizing this, at the beginning of the MPC meeting, people are supposed to declare conflicts of interest. If they are on the board of some private bank, then they have a conflict of interest. But many of these conflicts of interest are not visible. That is, I plan to join the bank. I expect to get an offer from the bank after I retire from the state bank. State bank has compulsory retirement at 60, but the private banks have no such rules, and they can hire people who have been favorable to them and so on, and there may not even be any written or verbal commitment or understanding. It will happen automatically. So there is this control which is automatically exerted on regulators. So this material is taken from the book called The Web of Debt by Ellen Brown. And she describes the creation of the Federal Reserve Bank. There were bank panics in 1873, 84, 1893 and 1907. And while other banks always went under, Morgan Bank always continued to survive and thrive. So the book puts forth the hypothesis that these panics were deliberately created in order to allow for in order to frighten the public and the government into creating a central bank, which would be massively beneficial for the private banks. And I used to believe that, but after reading the Minsky, I have realized that may not be true. So if you have the view that the system is stable, then a crisis has to be explained. And so if a crisis occurred, somebody caused this crisis. But if the system is unstable and continuously generating crises on its own, which is what Minsky says, then these things could just have happened naturally. And the fact that the Morgan's Bank survived doesn't mean that it caused these crises. It just means that it was more cautious. On the other hand, it is known that the big banks would create crises to drive little banks out of business so that they would have a stronger monopoly position. And this is also documented. So it can be a bit of both, that the system generates crises and the big banks take advantage of these crises they can even make them more critical and try to drive the lesser banks out of business, so they have less competition. The more stronger monopoly position they have, the stronger they are. So both of these things could be true at the same time. So in 1907, early in 1907, this is from the book, there was a plan offered that there should be a central bank which would prevent these crises. And then in late 1907, the crisis occurred. So there was this idea that in order to get this bill passed, they manufactured this crisis. It doesn't really matter for our purposes. So the Panic of 1907 was created in October. Then the Aldrich plan was created, which would create a central bank and control of the private sector, and the central bank would be the lender of the last resort. So the goal is that it would prevent these banking crises which were causing problems. So basically, the Aldrich plan failed in Congress because William Jennings Bryan was strongly opposed to this, because basically he said that this hands the power of money creation to the private banks and takes it away from the government. So after this bank failed, then basically the book, Ellen Brown says that the elections were manipulated. There were two candidates. There was Woodrow Wilson and there was another candidate who was opposed to the central bank plan. So the financiers financed a third candidate, Theodore Roosevelt. The only object of him was to take votes away from the second party, and so both of them lost, and Wilson won. Wilson was more amenable to their plan, and so and all of this is possible. I don't know if it's true or false, but it is. What is true is that such conspiracies have often been done, and in fact they are being done in the open today, because the in I think 2009 or 10, a law was passed which said that all of these corporations are persons, and when they give money to campaigns, it's their freedom of speech, and they can give any amount of money that they like. This meant that the businesses can buy elections, and they do. And they buy elections by giving money to both sides. So whoever wins is indebted to them, and they automatically, then it is impossible for them to sponsor bills against business. And we saw that, for example, Obama could not get bills passed, even though they were part of his campaign promises, that this is what I'm going to do. He could not touch the profits of the pharma sector, and he could not take actions against the gun lobby. It's too powerful for him. So at that time also it was clear that they didn't want to give, William Jennings Bryan didn't want to give power of money creation to the private sector. So Wilson was placed, and then there was a very clever compromise. The Federal Reserve Act was camouflaged in a way in which it seemed like the government has power, when in fact it was sold that, okay, the government will have power, the government will appoint the board, and there were many other, the government will print the money. So it seemed as if the government is in control, but in fact the amount of money to be printed would be in the control of the Federal Reserve, and the Federal Reserve would have a board which would be actually controlled by private parties. And even now the same situation is true, that even though the Federal Reserve Board is in some ways in control of the government, actually the people running the Federal Reserve are often private bankers. There's what's called a sliding door. They come from private banks, they go into the Federal Reserve, then they go back to the private bank, and they are not accountable. The decisions that they make cannot be challenged by the government. So this Glass Oven Act, which was also called the Federal Reserve Act, was passed by some subterfuge. It gave the impression of being something else, and the reality is something else. So the goal of Federal Reserve Bank was to prevent banking crisis. That was the whole thing. It was allowed to provide. It was the lender of the last resort to private banks, and basically that meant that there would be no crisis, because if the banks were in crisis, the bank would bail them out. But actually the result of this was the greatest banking crisis in history, which was 1929, and that is because prior to the Federal Reserve, the banks were very cautious. They were lending more money than they had, but they knew that there can be a run, and when there was a run on private banks, they would run to the other banks for loans, and usually there was mutual support. But sometimes when, for example, Morgan Bank was trying to drive out a rival, it would not make loans in order to make them collapse. And so they were cautious about the risk. But once the central bank was in existence, then they went to town. There was no longer any limit to credit creation possibilities, because whatever you create, you are covered by the Federal Reserve. So now the banks had a product to sell, and they can manufacture any amount of, but they can only sell to somebody who wants to borrow. So a whole culture of borrowing was created. There was this massive consumer culture, roaring 20s, that was created, and people were told to buy on future earnings. There was advertising became a big industry, because you wanted to sell people things that they didn't want, and so advertising, and then of course there were innovations on all sides in order to be able to sell people goods. The prices of automobiles came down, earnings were rising, so there was more income. So there were methods that were developed in order to make sales. Credit cards came later, but installment sales were started for the first time here. Previously, the culture did not allow installment sales for consumer goods because it was considered bad. Today, even now, if you want to buy furniture for your house, you shouldn't take a loan. It's considered a bad thing to do. But there, at that time, this was encouraged and made popular and made socially acceptable. That okay, you can buy a car on installments, you can buy a fridge on installments. In fact, the Sears company introduced the concept that you can buy anything on installment, and that is what turned into the credit card. But these were the things: homes, lands, stock market, Florida land schemes. You know, everybody can invest money in. Now, normally, the investments require large amounts of money, and large amounts of money are held by only those people who can afford. But now, people said, okay, you just put in your $100 into the Florida land scheme, and this will be a stock, and when the stock rises, you will make money. So if you put in $100 and it becomes $200, you are very happy, but you don't understand the risk that you are running. Now, Ponzi schemes especially, Ponzi himself was offered to pay 50% in 6 months' time, and did so for a while on just using other people's money to pay, and eventually he was caught and jailed. But you could also manipulate the stock market when for profits, and there were short sales. So what is short selling? Basically, I borrow shares and sell them at the current price, and I promise to sell the same shares later at a lower price. Always confuses me.
Stocks में सर दो positions होती हैं, long and short. Short is
Our financier will explain. Yes, go ahead and explain.
short is कि जब आप sell कर देते हैं stock है, आप उसको sell करने की option दे देते हैं, and you are playing long. जब आप
Short sale बतला, short sale.
Short का ये कि I'm going to sell my stocks. That's it. And long is I'm going to buy it.
A short sale is you will sell at a lower price tomorrow. Basically, a short sale is made when you think that the price is going to go down. So you promise to sell this stock 1 month from now at the current price. So you get the money and you hope to be able to buy the stock cheaper tomorrow so that you can make a profit. So this company shorted its own stock, and this can be done if you think that the company is going down. Also, you can make the company go down by just selling the dumping stock on the market. So this kind of manipulation is prohibited by the Securities Exchange Commission, but that was not in existence at that time. It came into existence later in order to prevent such practices. So by doing this kind of thing, you can actually fool the public for any amount. So there are two separate problems in understanding the stock market crash of 1929. First of all, how did the stock market crash happen? For that, you can see John Kenneth Galbraith, The Great Crash of 1929. I have uploaded this book. This provides a pretty clear explanation. Now, the second problem is more difficult. What was the connection between the crash and the Great Depression? So, according to some people, especially the real business cycle theorist, Lucas, when he was asked about the Great Recession and the stock market crash, and he said he was told that there was this bubble, he said no, actually it was not Lucas, it was Farmer, but I think they have the same position. They said what happened was that there was a downturn in the real economy, and this downturn, people in the stock market are smart. They said that okay, the economy is going down, so they started selling stocks. So that caused the stock market crash, and that made the recession worse. But basically, according to the real, it's not the finance. It was not the collapse of stocks that created the recession. The recession was on its way anyway, and the financial stock market collapse just made it worse. And exactly this is the position that was taken by some people about the Great Depression either. So what is the link between? So this is a question that is in dispute. Friedman has a different explanation. The stock market crash had nothing to do with the Great Depression. Basically, the stock market crash caused the collapse of banks, and that caused a collapse of the money supply, and this should have been prevented by the central bank, which could have injected the required money, and that would have prevented the Great Depression. This explanation has been now proven to be false because the Bernanke injected enormous amounts of trillions of dollars of money, but that could not prevent the Great Recession. So Keynesian explanation is that the savings of the public were wiped out. This is very important, and that collapsed the aggregate demand, as opposed to the dot-com bubble where the savings of the rich people were wiped out. Now if you look at the Keynesian consumption function, the rich people don't have any aggregate demand for goods. They are just the aggregate demand is low, but if you wipe out the savings of the public, then you kill the aggregate demand. And so that was one part, but there is another part which comes from Kalecki, which we have discussed briefly, that profits come from investments plus capitalist consumption. So now you see the part of the aggregate demand is the investment demand. Now this is not part of the original Keynesian explanation, but he says the aggregate demand for consumer goods collapses. But also the business, you see the business makes investment according to their desire for they're foreseeing how much profits they're going to make in the future. So we have discussed this briefly, that the demand for investment goods, demand build factories, hire labor, depends on how much you think you're going to be able to sell. So if your prognosis becomes gloomy, then your investment demand will go down, and that will also cause your profits to go down, because profits is partly determined by the investment. So when anticipated investments collapse, then profits collapse and firms shut down. And now the thing that last thing that I want to say here is that all of this, all of this is just talk. When you want to do serious study, then you have to build a model to see how these things work and what are the relative sizes. When you want to do calculations, then you have to create models, and these are the kind of models that I'm trying to teach you how to build. Once we start learning how to play with these fake models, then what you do is you do the process of calibration, try to match the model to the reality, make the numbers right, and then you play with this model, and then you see if the results match what actually happened. And if you can make the model behave like the real world, then you have some guess that maybe the mechanism that I am proposing is how the real world works. And this is the best you can do. You can never actually discover the real world, but you can make a model which creates something of a phenomena which looks like what happened in the real world, and that's a guess about what the real mechanism will be. Unfortunately, macroeconomics, as it is conventionally taught, does not work like this. Their model is validated because there is optimization by consumers and optimization by firms, and there's intertemporal equilibrium. That's enough. Whether or not it matches reality is not of concern to them. So the process of modeling as currently taught does not lead to successful models. Now, if you look at Galbraith endorses Kalecki's explanation. In the last part of the book, Galbraith, not quite like this. I mean, Galbraith says that basically investment is a device by which profits are being spent, and if investment collapses, if anticipated state of the economy is bad, then investment will collapse, and that will also collapse the profits, and this will cause end of the boom. So, as I said, the second puzzle, the first puzzle, why did the crisis happen? Why did the stock market collapse? That's in the Galbraith. The second puzzle is still not completely resolved. We have a much better idea today about what happened, and we will study again the global financial crisis in the house of debt, hopefully, and that will give us some more information. But that is where the ball game is currently, to build a good model which can explain the global financial crisis. I don't think there's currently any model in existence which does this, but there are many ideas which can be used to build such models.